Before we move on, a recap on what we learned last time. First, passive investing is not so much a theory as a matter of mathematical fact. There's a wealth of evidence supporting it, including the work of Nobel Prize-winning economists. And studies have consistently shown that when costs are factored in, passive investing produces better returns than active fund management. Of course, one of the golden rules of investing is not to put all your eggs in one basket. And the cheapest and most effective way to diversify is to invest passively. Why pin your hopes on the shares of just a handful of companies when for less money you can spread your risk by taking a stake in the entire market?
So there's a return advantage to passive investing, and then I also think there's a risk advantage in that when you're investing passively, you're basically trying to capture market returns. So you are not going to be surprised by your investment manager's underperformance, or you're not going to be heavily concentrated in a few number of securities where the risk would be that if those securities do poorly, that your results will be very bad.
There's a rule in real estate that the three most important things are location, location, location. Well, my rule in investments, the three most important things are diversify, 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 and then I'll give you three more: keep costs low, keep costs low, keep costs low. And the simplest way of doing that is a very broadly diversified, very low-cost index fund.
Active fund managers like to give the impression their funds do spread the risk you're taking. But while index funds often hold hundreds or even thousands of stocks, a typical managed fund will only hold around 50. So if you choose an active fund, you're opting for greater volatility and you're paying a premium for the privilege.
If you go overboard on active management, you will end up putting your money in too few baskets. You'll be undiversified. So you get very excited by tech stocks, or you get very excited by commodity stocks. So you put a lot of your portfolio into that. And if you do that, by concentrating your portfolio on certain areas of the market, you pick up a lot more risk than if you have a better balanced portfolio.
Depends how you sort of judge risk, but at the end of the day, you don't want all your investments to be invested in the FTSE 100. Equally, people don't want to have all their wealth in the house that they own. And if you use a number of passive investments, you lower the cost of that investment to you as an investor, and cost is a big drag on investors' performance over a 10 to 20 year term.
Active fund managers do offer more genuinely diversified investments. Recent years have seen a proliferation of so-called balanced, cautious and defensive funds, as well as funds of funds. But the charges on these funds are even higher. Among the most expensive funds of all are what are called absolute return funds, which are supposed to provide the investor with some sort of return whatever happens, but in reality often don't. Not only does the passive approach offer diversification within a fund, it also allows you to buy entire asset classes. There are index funds for virtually every type of asset, whether it's European equities, commodities or UK gilts. And even when you put your money into riskier assets, you're still spreading your risk by buying the whole market. To find out how investing passively can help you reap the higher rewards of riskier assets while smoothing out some of the volatility, I visited Austin, Texas. This is home to Dimensional, a passive investment company specialising in investing in small companies and so-called value stocks.
When we first started, people said, look, all this tests on market efficiency, all these tests were done on large cap managers because there weren't any small cap managers. So we feel confident that in the small cap area, that's the area where they'll be able to add value. But if you look at our evidence over the last 30 years, there are very few small cap funds that have done as well as we have in terms of performance.
If you ask people where active management works the best, the advocates of active management often cite the so-called under-researched or illiquid or unusual asset classes, small companies, emerging stock markets, And that seems plausible to many people. Well, if we look for the last 10 years, for example, at least among U.S. registered equity funds, putting aside sector funds like those just investing in gold or just investing in one single country like Russia, if we look at diversified equity mutual funds, the best performing mutual fund is an emerging markets value fund. All the active money managers are out there. They could have bought these same securities, several thousand of them that comprise this dimension of risk and return, but for whatever reason they chose not to. So it was a passive emerging markets fund focusing on this value risk dimension that, as it turned out, had the highest return among all diversified equity funds for that 10-year period.
An argument often put forward by proponents of active fund management is that when asset prices fall, they often do so across the board. True, an index fund tracking, say, the FTSE 100 will rise and fall in direct correlation with the index itself. But despite the disappointing performance of equities since 1999, a passive investor would still be sitting on a sizable profit now, as long as they'd spread their investments, particularly when dividends are taken into account. On average, they'd also be better off than if they'd put their money into actively managed funds. And so, to that other golden rule of investing, always take the long-term view.
Best thing anybody who's going to be an investor could do is to spend a fair amount of time, 4, 5, 6 weekends, reading past issues of newspapers. Start with the 1930s, then read the 1940s, then read the 1950s, and keep on going until you have the feeling, gee, I really know a lot about markets. Then the main thing I'm learning is the data that's presented and the stories that are written up don't really have much significance over the long, long run.
The remarkable thing about finance is you cannot predict at all what the market is going to do tomorrow, but you can predict with reasonable accuracy what the return, at least of some asset classes, is going to be over very long periods of time. You might look at the past 10 years and say, well, it's been a lost decade. U.S. equities have had, over, depending upon the 10-year period you measure, about a zero return. But there are other things that have done quite well. Now, that doesn't mean that pattern is going to continue into the future. In fact, I can guarantee you that particular pattern won't occur into the future. It'll be a different pattern of returns. But the point is, if you own all of those asset classes, you won't screw up. You won't make up any big mistakes.
So let's summarise. Investing passively is the cheapest and most effective way to spread your risk. Because their holdings are restricted to a relatively small number of stocks, active equity funds are more volatile than passive ones. Active fund managers charge a premium for funds that invest in more than one asset class. And over the longer term, once charges are taken into account, the passive investor will always fare better than the average active investor.